Welcome to the Finance Podcast. The topic of this episode, concrete applications of artificial intelligence in investment management, with Professor Dr. Florian Weigert from the University of Neuchâtel.
So, guten Nachmittag, good afternoon, everyone. I think I will do the presentation in English, since I know there are some English-speaking people that don't speak German here. It's my big pleasure to welcome you to my presentation on AI, in particularly machine learning for investment management. So I'm very happy that so many people are interested in AI in machine learning. So we see there's a big trend, a big development going on in this kind of topic, especially also for portfolio management, for investment management. My name is Florian Weigert. I am Professor of Financial Risk Management at the University of Neuchâtel. If you want to contact me, I think the best is to write an email to me. Very happy to have more explanations, or if you have some kind of, practical ideas where you need some academic input, very happy to talk to you. So what I'm talking to do, this is an educational speak, so I would love to give you some ideas. What is AI, what is machine learning, and how can we possibly apply it for finance, for investment management? And I will try to give you 3 ideas how you could apply this. Stock selection. So as a portfolio manager, how can you use machine learning to select stocks? Fund manager selection. As an investor, you would love to know what are the most successful funds in the future. How can we maybe determine those? And finally, also technical analysis. So can we try to get some kind of prediction whether a stock is going up or down by looking at its past trend. But first, let me shortly give you an overview what AI and what machine learning is. So we think we only have 25 minutes. It will be a very, very rough introduction. It's not possible, of course, to go into very big details. But I think you all know about AI. You heard a lot probably in the media as the simulation of human intelligence processes by computer systems. To distinguish AI and machine learning, often this is, simultaneously used, but machine learning is actually a subset of AI. So AI is bigger, machine learning is a subset of AI, and it summarizes algorithms that can recognize and learn from historical data, basically without being assisted by humans. So you have a lot of data available, for example, you have big data available, and you want to form some predictions based on this data. So you could use machine learning algorithms to get some optimal forecasts. So this is the idea. And what are examples? Image recognition. So if you put in a lot of pictures of cats and dogs, at some point in time, the algorithm will learn to distinguish this is a cat, this is a dog, if you give them a new picture. Text classification. So you can give texts into this machine learning algorithm, and you can ask the algorithm, is there positive, is there negative sentiment? Language translators, DeepL is a very prominent one, and of course chatbots like ChatGPT, which I think most of us probably nowadays use in their daily work. For investment management, let me give you my perspective or some idea how you could use it, and this is particularly in the area of stock selection and mutual fund selection now. So what is our basic idea? So what we want to form some optimal idea how a future stock return, a future fund return is going to be looking like. This is what I think all investors would love to know. I would love to know what are the stocks that are going up tomorrow and what are going down tomorrow. But this is, of course, very, very difficult to do. Markets are very efficient. It's very difficult to predict returns. However, what could you do? So we have a lot of data nowadays available. Let's stay with the stock selection. So when you want to try to predict a future stock return or stock prices, what would people use? You can use, for example, price to earning ratio. You could look at past returns of the stock. You could look at the industry classification. You could look at very different accounting signals. You could look at different sentiment signals. You could look at past volume, past prices. An enormous amount of data is nowadays available. And I would love to formulate that as these axes, which are basically known today. And we want to use as much data as possible to predict something for the future. So what could you do? In the first step, and now it's going to be a little bit quantitative, so I hope you like statistics. Everybody loves statistics, I hope, in this room. So what can we do? The basic idea, what a lot of people and also quant investors are doing, is running regressions. So what you do is you want to form some kind of predictive return in the future, and you have a lot of data available, say 200, 400 variables. What you could run is you run a so-called linear regression. So you take all of the possible data known today, and you form some kind of relationships between future variables and these variables over the past 20 years or something like that. You get some kind of so-called beta estimates here, and then you can predict, based on past returns, what will be the future return. Often, what you get here is not very informative. The problem is that often you have, if you put in too much of those variables, you are likely to overfit the data. So this is what people call overfitting, some kind of in-sample training period. This will not give you very good future predictions. So machine learning wants to avoid overfitting. So what can we do? There are different models. Machine learning model 1, I call it constrained regression. The idea here is that you let the algorithm decide, based on the past data, what are the most informative variables that predict stock returns and what are not very much informative variables. So the machine learning algorithm selects only the used, so that the ones that have the biggest impact, and tries to form predictions based on future returns only on a subset of variables, which could be, for example, price to earnings ratio or the past return. But this is automatically selected by the algorithm. Second model, dimension reduction. Principal component analysis is one part of that, so maybe you have heard about that. The idea is here, again, you have this large set of possible predictive variable, and the algorithm tries to reduce it again and form averages of those. So you average the predictive power of those 100, 200, 300 variables to get the only averages that you have some kind of predictive power, which is not really about caring about too much about this overfitting anymore. So it's condensed information by taking averages, basically. Model 3, regression trees, as we call it, called sometimes random forest gradient boosting. Here you let the algorithm decide, based on so-called partitions, what kind of optimal forecasts one can get if we have some kind of existing variable. So it could be that it says, okay, for the big stocks, you get a return prediction of 0.10 over the next year, for example. But for the smaller stocks, it is good to make some distinguish between high book-to-markets and low book-to-market stocks. And for those kind of variables, you get another kind of forecast possibility. This is, again, just based on data, just based by the algorithm. And finally, neural networks. This is also a very promising and prominent algorithm for machine learning. It's telling you, you have these inputs, and the neural network is focusing on interactions and nonlinear transformations of these variables. So if you put in price-to-earning ratios into your algorithm, past returns, volume, sentiment indicators, and you say to the algorithm, please form an optimal prediction for this kind of stock, it tried to make some kind of interaction between these variables and nonlinearities to form, based on historical data, an optimal forecast possibility. This is the most complex algorithm, and usually it needs a lot of data. By a lot of data, I really mean millions of data often, 100,000 millions of past data to form a good forecast. And still, in finance, because markets are so efficient, the predictive power of such algorithms is rather low. So it's not easy to get any kind of very strong predictions for stock returns. If this would be possible, I think we all would be rich immediately. So to summarize, ML models are algorithms that look for optimal predictions based on a large number of so-called features and mitigate the risk of overfitting. For example, based on the caring about nonlinearities and interaction effects, it could be that, for example, the relation between size and future returns is only negative for the largest companies, but not for the mid companies, for example. So this is a nonlinear relation. And the machine learning algorithm often finds or tries to find these interaction effects. So it could be, based on past data, that it finds the successful stocks were those with high book to market and high profits at the same point in time. So these interactions, and this is really, I think, a good pattern for machine learning models, maybe we don't see that. So we maybe know, okay, it's good to invest into value stocks. But the machine could probably also see it's not only value, it's the combination between value and profitability. And machine learning can potentially detect these kind of drivers that can predict returns. And that's the beauty, I would say, of these machine learning models. So now let me give you some applications. I'm basing my applications on 3 academic papers. So I'm an academic person, so I'm giving you some input also from the university. And you will probably see some numbers that are really high in profitability. I will say something about that. Academics and practice are often 2 pairs of shoes, so you don't necessarily get completely the same results when you would put them into practice. So let's have a machine learning stock selection model. Idea, you are a portfolio manager. You want to select individual stocks. This paper was looking at the US. It's rather dated nowadays, 1957 to 2016. Each month, they were looking at 168 potential variables that could be related to future stock returns. So they looked at, so these are all quantitative measures. Stock size, the illiquidity of a stock, the book to market value, how profitable it was, past monthly return, and so on. And based on these 168 fundamental variables, they were running, based on past data, a machine learning model, different machine learning models, And the machine learning model proposed 100 stocks that are predicted to have the highest next monthly future returns and the ones that the machine predicted to have the lowest future return. So what were the results of the study? First of all, what was the most successful model? So here you see different models, what they were running at. And in this study, they were finding out for stock returns, neural networks, so NN stands for neural networks, were the most successful models in predicting future returns. NN2, NN3, NN4, NN5, this is indicating the so-called layers within a neural network. So the higher the number of layers within a neural network, the more complicated the model is getting. And not necessarily you get better results if the model is getting more complicated. What were the most important drivers of returns? It was the past monthly return. So still there is some kind of relationship between past returns and future returns. It was the volume. It was the maximum return, some kind of other momentum factors, and turnover, idiosyncratic volatility, different measures that were shown to be important to be driver of stock returns. That's showing markets are not completely efficient, basically. So you have some kind of predictive power, but still it's difficult to find out what are the main predictors. And in terms of investment performance, you get a very, very beautiful number here based on this academic paper. They were finding that buying stocks with the highest predicted return and selling stocks with the lowest predicted return would yield a monthly alpha or return of 2% per month. I would not think that you would get this in a practical world because they were not accounting, for example, for transaction costs. So this is like an academic paper return, but still, it seems that if you implement that in, I think, a nice and efficient way, it could be that you're getting an alpha with this kind of investment strategy. So this was the stock selection model. Now we're getting to the fund manager selection. So as an investor, maybe as a pension fund investor, you would love to know what are the most successful funds in the future. And actually, this is a study that I was preparing with two other co-authors from my site. And we were looking at this in the universe of actively managed US equity funds. So we also looked at data from the US, active US managed funds. And we're looking at monthly data from 1991 to 2022. We use basically Morningstar data. What we do is the following idea. We want to look at different kinds of characteristics of the fund, of the portfolio of the manager, and also of the fund manager itself, himself or herself. Here, at the moment, we use 19 of these characteristics. For example, what was the fund's past return? It's R-squared, two-factor models, it's expense ratio, characteristic selectivity is a measure that looks at how much is the fund manager successful in the stock selection in the portfolio. And we were also looking at diversity of the team, and we want to go more into this direction that what kind of fund manager characteristics are driving the results. At the moment, we don't have it here in this kind of model, but we're now looking into this in a new version of our academic paper. Based on these kind of characteristics and a dimension reduction machine learning model, we then say to the machine or to our algorithm, please tell us every year what are the most successful funds over the next year, based on our quantitative data, based on our machine learning model. Then we would invest into the top decile funds. So the top 10% funds on a yearly basis. Every year we would do that. I know it's not realistic. Maybe you cannot do that, and we don't account for any kind of front end or back end fees at the moment. What are the results? They are also looking, I think, promising. We find that our kind of model selects funds relatively good. So we can distinguish between the good funds and bad performing funds. So the funds that the machine learning model is selecting outperform the ones that we predict to have the worst return by 4.3% per annum. And this is risk adjusted and after fees. And I think this is also, very important. The funds that we can select with our model beat the average active US equity fund by 2.5% per year. And we can even beat the average passive fund. So we can select active funds that beat the passive fund, which gives rise to the idea that active management is possibly bringing value. It's not only that we should always invest maybe into passive funds, but there are some active fund managers who bring value, and this algorithm seems to indicate we can find them by looking at certain characteristics, such as the expense ratio, for example, the past return, or portfolio characteristics of the manager. So, two additional results, what we find is that our results getting better if we use more information on funds and fund managers. So maybe it's not the best idea to base investment decisions only on past returns. I think that is what a lot of investors actually doing. They look, what was the performance of the fund? And then we possibly invest into the best performing fund manager in the past. But our results indicate that's not all. We should look also into different things. The expense ratio, how active the fund manager is. Also how he or she is putting their portfolio together, how successful is doing, how efficient are they doing that. So it's not only about past returns, it's also about other things that matter. And here you see some kind of graph that shows what, in our sense, were the most important drivers of our machine learning model. And I think very important, GT and CS were the most important ones. These are two characteristics who look how successful and how good a fund manager is putting stocks in their portfolio together. So how good are they selecting stocks with regard to a benchmark? That is mainly what these two measures are showing. Also, expense ratio is important. We find the so-called skill index is important. But many things matter here. And we're coming already to the last application, technical analysis. Technical analysis, people still do that a lot, in my opinion. People sometimes say it's a pseudoscience, maybe. Why should this work if markets are efficient? So why not having a look also at machines doing that? So one, I think, prominent paper of 2023 were looking at this, and they were looking at images. So they were looking at price images of stocks, past 5-day, 20-day, 60-day stock price charts from individual US stocks from 1993 to 2019. So you can imagine that's a large collection of price charts. So you put a lot of graphical data here into the machine. If they're doing it, they were then looking in the past based on what kind of price charts, what was, for example, over the next day or over the next week, the price development. Was it positive? Was it negative? And if you now, based on such kind of price charts, detect nowadays this price chart is coming again, then you would say the machine, okay, then we go into a buy or a sell decision. So this is what they're doing, and they're applying a so-called convolutional neural network into this. This is a neural network normally used for graphics, like figures, to detect some kind of figures and to get some kind of forecast based on figures. Here also a positive and very interesting result. This machine learning model achieves an out-of-sample classification accuracy of predicting the correct price trend of 53%. What does that mean? So if you would do it by chance, you would get a 50% predictive power. So the machine is slightly better than a random buy or sell decision. But a 53% predictive accuracy can get you very rich. It's not that you have like 90% or 100% predictive power. This will never occur on financial market because market prices are so noisy, markets are so efficient. But if you get anything which is above, significantly over 50%, that can give you some kind of real input to your investment strategy. And as this already implies, a trading strategy based on buying stocks with positive trend forecast and selling stocks with negative forecasts got a risk-adjusted monthly return of more than 2%, even again, I think not taking account of any transaction costs here, and also thinking that we are always able to sell stocks. They also did some checks in other markets worldwide, and they find it's profitable in 20 out of 26 markets. When I remember correctly, the Swiss market was not one of them. So I'm not sure what happened in the Swiss market, but I don't want to put that too much emphasis on that here. So I hope I could give you some input from the academic side, how we could possibly use machine learning for investments. I think machine learning, AI, have very, very promising applications in investment management. Stock selection can be improved by machine learning. Fund manager selection can be improved. Technical analysis can be improved. But that's not all. Of course, you can also have a look at portfolio optimization. I'm not covering that. Market timing. That's possibly the holy grail, I would say, of investing. Can we detect when markets are going up, are going down? If we could get some inputs based on past data and machine learning model, that would be very, very cool. Or also the generation of alternative data. So you can use algorithm, for example, to get some signals based on newspaper articles, based on social media, Twitter posts. Anything is now possible to analyze. And I think you see that we're going really into a world where data is very valuable and processing of data is very important for portfolio managers. Nevertheless, some caveats. I feel that some results that I'm showing are very sensitive to the quality of input data. Often these machine learning models are seen as black box algorithms, so it's not really clear how the machine learning is, how they do it, or what the machine learning model is doing. So there is a lot of research going into explainable machine learning. So you want to understand what's going on. The results I showed you are valid for a specific market and time period. Often also real-time trading strategy is limited because you often need data inputs and then immediately trade on this. So often there is some kind of lag between those, which is often not accounted in these studies, and also transaction costs are not accounted for. Also, if you want to implement studies from academia in practice, note that I would say there's an academic bias. Academics want to get published, and positive results are much more likely to get published than non-significant results. So in my feeling, when I was also trying to replicate some of those studies, you don't get to these very, very profitable trading results. But nevertheless, I think these are very interesting inputs. Thank you so much. It was a pleasure for being here. And if you have some questions, I'm still available to have these.
I have a question. What's your view on the existing chatbots like ChatGPT, Grok 3, Gemini, to realize these use cases?
So these are large language models. So it's a little bit different that I proposed here. Generally, these large language models also work with machine learning algorithm in a different way, with more text-based models. So there are different studies who show that ChatGPT-4, for example, can give already some very valuable investment advice. But I feel one problem that some academic studies are showing that, because often you don't see what kind of time information the algorithm is using. So if you say you try to do a study based on historical data, and you think, okay, what does the ChatGPT tell me to buy? And what were the results? Often, it's not really clear what information ChatGPT knows it. Maybe it takes some information that is afterwards coming from. And this is often a problem in some studies looking at ChatGPT as an information medium. So I feel it's a very, very useful resource, but I'm not sure whether this is going to be beating markets consistently if you would look at the advice from it.
Thank you.
Thanks very much.
Yes.
I have a question about your last example, academic work, I think CNN. That 53%, so is this study based on the assumption that visual input to traders is a factor rather than numbers?
It's a good question. So this study was looking at graphs. And of course, you could say we can also have a look at the numbers. It's basically the same information what you're providing. What they argue in the academic paper is that they are having these convolutional neural networks which work better on graphs. So they were using graphs to get some kind of forecast. I think that it does not matter too much whether you look at the past data or you look at the past visualizations. So it's not really clear to me why this is improving against just using data.
This paper, I know a little bit about this paper myself. The idea is that, first of all, they tried to move window by window, one day by each day, and they tried to predict and see. But convolution, they completely work differently than prediction, but they still use matrices. So it's the same. They still use numbers.
Yeah.
Because computers are a binary system, so they use numbers. It's just that it works pixeling, so that's why. But you can still use the proper prices to predict going forward.
Too. Yeah. No problem. My plan. At the moment, so we have data until 2022. So we have not started to run like a real-time going forward indication. But we're planning to have a tool that maybe is also then used by practitioners, where you can put data in, and then we get some kind of lists of funds that are possibly outperforming versus non-outperforming in the future. So it's basically, at the moment, an out-of-sample back test. Thank you so much.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory.